The global financial system is a complex beast. Since World War II, central banks have played a crucial role in managing their nation's economies. One key aspect of this role is managing reserve assets. These assets act as a financial safety net for countries. After the war, the world looked to a new order. The Bretton Woods Agreement emerged, pegging global currencies to the US dollar and the dollar to gold. This system established the dollar's dominance and shaped the financial landscape for decades. Initially, gold reigned supreme as the primary reserve asset. Central banks held a significant portion of their reserves in this precious metal. It was seen as a safe haven, a store of value that endured economic turmoil. However, the world began to shift in the 1970s. The Bretton Woods system collapsed and the gold standard was abandoned. This change led to a decline in gold's popularity as a reserve asset. Central banks diversified, turning to other assets like US Treasury bonds. These bonds offered a steady return and were seen as relatively safe. This shift marked a turning point in how central banks managed their reserves. Despite its decline, gold never truly lost its luster. In recent years, we've witnessed a resurgence of interest in gold from central banks. They've been steadily increasing their gold reserves, driven by several factors. One key factor is the desire to diversify away from the US dollar. The dollar's dominance, while significant, has come under scrutiny, particularly with the rise of other economies. Gold, being a tangible asset not tied to any specific currency or country, provides a hedge against geopolitical uncertainty and potential risks associated with holding a single dominant currency. This trend towards gold accumulation is particularly noticeable among emerging market central banks. They are looking for ways to safeguard their economies in an increasingly interconnected and volatile global financial system. Gold, with its historical resilience, offers a sense of security and stability that other assets may not provide. As central banks navigate this shifting landscape, a new player has emerged on the scene. Bitcoin, this digital currency, born in the aftermath of the 2008 financial crisis, has sparked intense debate about its potential role in the global financial system. Some proponents argue that Bitcoin possesses characteristics that could make it an attractive reserve asset. Its decentralized nature, operating independently of any government or financial institution, is seen as a potential hedge against geopolitical risks and inflationary pressures. Furthermore, Bitcoin's limited supply, capped at 21 million coins, appeals to those who see it as a potential store of value, similar to gold. However, Bitcoin's volatility remains a significant concern for central banks. Its price has experienced dramatic swings, which could undermine its role as a stable reserve asset. Additionally, its relatively small market size and limited acceptance in global trade pose challenges to its widespread adoption as a reserve currency. Central banks are entrusted with the critical responsibility of maintaining their country's economic stability. This task involves carefully managing reserves to navigate economic crises and ensure a functioning financial system. Reserve assets play a crucial role in this endeavor. They are the financial arsenal that central banks deploy to defend their currencies, manage inflation, and provide liquidity during times of crisis. One primary use of reserve assets is foreign exchange intervention. Central banks buy and sell currencies in the foreign exchange market to influence the value of their own currency. For example, if a central bank wants to prevent its currency from depreciating too rapidly, it can sell its reserve assets, such as US dollars, and buy its own currency, thereby increasing demand and supporting its value. Reserve assets are also crucial in managing economic crises. During the 2008 financial crisis, for instance, central banks around the world injected massive amounts of liquidity into the financial system by utilizing their reserve assets. They bought government bonds and other financial instruments to prevent a collapse of the financial system and stabilize their economies. The purpose of reserves. Central banks don't hoard reserve assets for mere accumulation. These assets serve specific purposes, acting as tools to achieve various economic objectives. They are deployed strategically to manage exchange rates, control inflation, and ensure financial stability. Understanding these purposes is crucial to grasping the rationale behind central banks' reserve asset choices. One critical purpose is influencing exchange rates. Central banks can buy or sell their own currency in exchange for reserve assets to impact its value. This intervention can be used to make exports more competitive by lowering the currency's value or to curb inflation by strengthening the currency. Another vital purpose is managing inflation. By holding reserve assets that appreciate in value, central banks can offset inflationary pressures. Conversely, if inflation is low, they can adjust their reserve holdings to stimulate economic growth. Gold versus dollar versus Bitcoin. When choosing reserve assets, central banks carefully evaluate various factors. Safety, liquidity, and return are among the most important considerations. Let's compare gold, the US dollar, and Bitcoin based on these criteria. Gold has long been revered for its safety. It's a tangible asset that retains its value even during economic turmoil or geopolitical uncertainty. However, gold doesn't generate any return and incurs storage costs. Its liquidity, while generally good, can be affected by market dynamics. The US dollar benefits from high liquidity due to the depth and size of the US financial markets. US Treasury bonds, a common reserve asset, offer a relatively safe and liquid investment with a modest return. However, the dollar's value can fluctuate and its dominance is being challenged by other currencies. Bitcoin's safety is debatable. Its decentralized nature provides resilience against government interference, but also exposes it to regulatory risks. Its liquidity is improving, but still lags behind traditional assets. While Bitcoin has shown potential for high returns, its volatility makes it a highly speculative asset. Geopolitics and finance. Geopolitical events can significantly impact central banks' reserve asset decisions. Political instability, economic sanctions, and trade wars can all influence the perceived safety and stability of different assets. Central banks must adapt to these changing dynamics to safeguard their economies. For instance, the ongoing sanctions against Russia have prompted some countries to reduce their reliance on the US dollar and explore alternative reserve assets. This trend highlights how geopolitical considerations can drive diversification efforts among central banks. The increasing trade tensions between major economies have also contributed to this shift. As countries seek to reduce their exposure to specific currencies or regions, they may diversify their reserve holdings to mitigate potential risks arising from trade disputes or geopolitical alliances. A new financial order? The global financial order is in a state of flux. The dominance of the US dollar is being challenged, and central banks are actively seeking to diversify their reserve assets. This evolving landscape presents both opportunities and challenges for the international monetary system. The rise of digital currencies like Bitcoin adds another layer of complexity. While it's unlikely that Bitcoin will replace the US dollar or other major reserve currencies anytime soon, its emergence signals a potential shift towards greater digitalization in the global financial system. Central banks are closely monitoring these developments and exploring the potential implications of digital currencies for monetary policy, financial stability, and the international monetary system. The coming years will likely witness further experimentation and innovation in this space. A transformative era. We are living in a transformative era for central banking and the global financial system. The traditional role of reserve assets is evolving, driven by geopolitical shifts, technological advancements, and the emergence of new players like Bitcoin. Central banks face the challenge of navigating this complex landscape while ensuring economic stability and mitigating risks. Their decisions regarding reserve assets will have profound implications for the international monetary system and the future of finance. As we move forward, it's crucial to foster dialogue, collaboration, and innovation to shape a more resilient, inclusive, and sustainable global financial system that benefits all. If you found this video informative, like and subscribe for more financial information.